At 3:17 a.m. Eastern Time, while Western markets slept, the Bank of Japan made an announcement that will be studied in economics textbooks for generations. After 37 years of unconventional monetary policy, after pioneering quantitative easing, after implementing negative interest rates, after defending yield curve control against relentless market pressure, the Bank of Japan surrendered. The policy rate was raised, the yield curve control band was abandoned. The largest monetary experiment in modern history was declared complete. The yen surged 9% against the dollar within hours. Japanese government bond yields spiked to levels not seen since 2008. The Nikkei futures halted trading twice on circuit breakers. But these are merely the visible tremors. The earthquake is what happens next. Japan is not a small economy making a policy adjustment. Japan is the third largest economy on Earth. It holds over $1 trillion in U.S. Treasury securities, the largest foreign holder. Its institutional investors hold trillions more in global bonds, equities, and real estate. For decades, Japanese capital flowed outward, seeking yield that did not exist at home, financing deficits in other nations, suppressing borrowing costs across the developed world. That flow is now reversing, not gradually, not partially. The Bank of Japan just gave Japanese institutions a reason to bring their money home. And when the largest creditor nation in history begins repatriating capital, the nations that depended on that capital discover what it means to lose a buyer of last resort. This is not a Japanese story. This is a global story. And it began 3 hours ago. There is a tendency to view central bank decisions as isolated policy choices, technical adjustments made by technocrats in response to domestic conditions. This framing is dangerously incomplete. Central bank policies exist in a global system. They interact. They depend on each other. They create equilibria that persist for decades, until they don't. The Bank of Japan's policy was not merely Japanese monetary policy. It was a load-bearing pillar of the global financial architecture. Zero interest rates in Japan meant that Japanese capital had to go somewhere else to earn returns. That somewhere else was the United States, Europe, Australia, and emerging markets. Japanese insurance companies bought U.S. corporate bonds. Japanese pension funds bought European government debt. Japanese banks financed carry trades that provided liquidity to markets worldwide. This was not charity. It was arithmetic. When domestic yields are zero or negative, capital seeks yield elsewhere. The result was a 30-year subsidy to global borrowing costs. Nations could run larger deficits because Japanese buyers absorbed their debt issuance. Corporations could borrow more cheaply because Japanese institutions competed for their bonds. This subsidy was invisible. It was embedded in the structure. It was taken for granted. It is now ending. The Bank of Japan's decision does not merely affect Japan. It removes a pillar that other nations did not realize they were standing on. The question is not what Japan will do next. The question is what happens to the structures that were built, assuming Japanese capital would always be available. The history of Japan's monetary experiment provides context for what is unfolding. In December 1989, the Nikkei stock index reached 38,915, a level it would not see again for 34 years. Japanese real estate was valued at levels that defied comprehension. The Imperial Palace grounds in Tokyo were said to be worth more than all the real estate in California. Then the bubble collapsed. The Nikkei fell 70% over the following years. Real estate values fell 80% in some areas. Banks were left with non-performing loans that they could not acknowledge without admitting insolvency. The policy response defined the next 3 decades. Rather than allow defaults, restructuring, and the painful clearing of bad debt, Japanese authorities chose a different path. Interest rates were cut to zero. Quantitative easing was invented. The Bank of Japan began purchasing government bonds to inject liquidity and suppress yields. The goal was to prevent deflation, to support asset prices, to give the banking system time to heal. The policy worked, in a sense. Japan avoided a catastrophic depression. The banking system survived. Social stability was maintained. But the policy also created dependencies. The Japanese government, facing an aging population and rising social costs, continued borrowing. Government debt rose from 60% of GDP in 1990 to over 260% today, the highest ratio of any developed nation. This debt was sustainable only because interest rates were zero. At 260% of GDP, even a small increase in borrowing costs consumes the entire government budget. Japanese corporations, facing zero domestic returns, sent capital abroad. They became the financiers of the world, not by choice, but by necessity. Japanese households, facing zero returns on savings, either accepted the erosion of their purchasing power or took risks they would not otherwise have taken. The entire Japanese economy reorganized itself around the assumption that interest rates would remain at zero indefinitely. That assumption just ended. The mechanism of what happens next is already in motion. When Japanese yields rise, Japanese government bonds become attractive to domestic buyers for the first time in decades. Japanese insurance companies currently hold approximately $400 billion in foreign bonds. These bonds were purchased because domestic alternatives offered no yield. Now domestic alternatives exist. Japanese pension funds hold even larger foreign positions. The government pension investment fund alone manages over $1.5 trillion, with significant allocations to foreign assets. The decision calculus has changed overnight. Why hold U.S. Treasuries yielding 4% with currency risk when Japanese government bonds now yield 3% without currency risk? Why hold European corporate bonds with credit risk when domestic bonds offer comparable yields with sovereign backing? The answer, for many Japanese institutions, is that they shouldn't. They should repatriate. This repatriation does not require panic. It does not require a crisis of confidence. It requires only rational portfolio adjustment in response to changed conditions. But the effect of rational adjustment, multiplied across trillions of dollars, is systemic. When Japanese institutions sell foreign bonds, those bonds must find new buyers. If new buyers are not available at current prices, prices fall. When prices fall, yields rise. When yields rise, borrowing costs increase for governments and corporations that have become dependent on low rates. This is the transmission mechanism. Japan adjusts policy. Japanese capital repatriates. Global yields rise. Borrowers who assumed low rates would persist discover they cannot afford their debt loads at higher rates. The Bank of Japan did not intend to destabilize global markets. It intended to normalize domestic policy after decades of emergency measures. But in an interconnected system, normalization in one node creates stress in others. The stress is now propagating. Historical parallels illuminate what may unfold. In 1994, the Federal Reserve began raising interest rates after a period of low rates that had fueled a bond market bubble. The rate increases were modest, 3% over 12 months, but the effect was catastrophic for leveraged positions that had assumed low rates would persist. Orange County, California, declared bankruptcy, the largest municipal bankruptcy in American history at that time. Mexico experienced a currency crisis that required U.S. intervention. Bond markets globally experienced what traders called the Great Bond Massacre. The trigger was a policy normalization that seemed reasonable in isolation, but interacted with leverage structures in unexpected ways. In 1997, the Asian financial crisis began with Thailand abandoning its currency peg. Capital that had flowed into Asian economies suddenly reversed. One by one, Asian currencies collapsed. Indonesia, South Korea, Malaysia, nations that had seemed like economic miracles, discovered that miracle was borrowed. The crisis spread not because Asian economies were connected, but because the capital that funded them was connected. When investors lost money in Thailand, they sold positions in Korea to raise cash. When they lost money in Korea, they sold positions in Indonesia. The contagion was not geographic, it was financial. It followed the money. Japan's policy shift has the potential to trigger similar dynamics. Japanese capital is embedded in markets worldwide. When that capital begins to exit, it does not exit in isolation. It exits simultaneously from multiple positions. And the exit creates selling pressure that forces other leveraged players to exit, creating more selling pressure. This is how financial crises propagate, not through direct links, but through the behavior of capital seeking to reduce exposure simultaneously. The carry trade deserves specific attention. For decades, the yen carry trade has been one of the largest and most persistent trades in global finance. The mechanics are simple. Borrow yen at near zero interest rates, convert the yen to another currency, invest in higher yielding assets, pocket the difference. At its peak, the yen carry trade was estimated at over $20 trillion in notional exposure. Not all of this was explicit currency speculation. Much of it was embedded in corporate financing, in mortgage markets, in institutional portfolios. The trade works as long as two conditions hold. Japanese rates stay low, and the yen does not appreciate. Both conditions just broke. Japanese rates are rising. The yen is surging. Every carry trade position is now losing money on both legs. The yield differential is narrowing. The currency move is creating losses that exceed years of accumulated carry. When carry trades unwind, they unwind violently. Borrowers must buy yen to repay their loans. This buying pushes the yen higher. The higher yen creates more losses for other carry traders. They must also buy yen. The feedback loop accelerates. This is not theoretical. This is happening in real time. The yen's 9% move in hours is evidence of carry trade unwinding already in progress. The question is how large the unwind becomes and which markets absorb the stress. The U.S. Treasury market sits at the center of this dynamic. Japan holds over $1 trillion in U.S. Treasury securities. This makes Japan the largest foreign holder of U.S. government debt. These holdings were not acquired for investment returns. They were acquired as a byproduct of currency intervention, the Bank of Japan selling yen and buying dollars to prevent yen appreciation, then investing those dollars in treasuries. They were also acquired by Japanese institutions seeking yield that domestic markets did not provide. If Japanese institutions begin selling treasuries to repatriate capital, the U.S. government loses a major buyer at the exact moment it needs to finance record deficits. U.S. federal debt exceeds $35 trillion. Annual deficits exceed $2 trillion. This debt must be continuously refinanced and expanded. The assumption embedded in U.S. fiscal policy is that buyers will always be available. That assumption rests heavily on foreign demand, particularly Japanese demand. If Japan becomes a seller rather than a buyer, Treasury yields must rise to attract alternative buyers. Higher Treasury yields mean higher borrowing costs for the U.S. government. Higher borrowing costs mean larger deficits to cover interest payments. Larger deficits mean more Treasury issuance. More issuance requires even more buyers. This is the doom loop that fiscal analysts have warned about for years. Japan's policy shift may be the catalyst that activates it. There are those who argue that markets will adjust smoothly. They point to the depth and liquidity of Treasury markets. They note that other buyers, domestic institutions, other foreign central banks, can absorb Japanese selling. They argue that the Federal Reserve can resume quantitative easing if necessary. These arguments contain technical merit and fundamental blindness. Yes, markets can adjust. The question is at what price? If Japanese selling pushes Treasury yields from 4% to 6%, the market has adjusted. But that adjustment reprices every asset in the global financial system. It reprices mortgages, corporate debt, municipal bonds, equities, real estate. The adjustment is not smooth. It is dislocating. And the argument that the Federal Reserve can absorb the selling through quantitative easing contains its own trap. If the Fed monetizes Japanese Treasury sales, if it prints dollars to buy the bonds Japan is selling, it validates every concern that drove Japanese institutions to sell in the first place. It confirms that the dollar is being debased. It accelerates the loss of confidence in paper assets. The Fed cannot simultaneously defend Treasury prices and defend dollar credibility. These goals conflict when the pressure is sufficient. Japan's policy shift may create pressure sufficient to force that choice. Gold's behavior during this transition follows a predictable pattern. In the hours following the Bank of Japan announcement, gold rose $63, a move that would have been headline news in any other context, but was overshadowed by currency and bond market chaos. This is not coincidental. When major central banks lose control of their policy frameworks, when currency relationships that persisted for decades suddenly break, when the stability of sovereign debt markets comes into question, gold responds. Not because gold traders are making predictions, because gold reflects the collective response to uncertainty. The yen was supposed to be weak forever. It just surged 9%. Japanese yields were supposed to stay near zero forever. They just spiked to multi-year highs. The assumptions that underpinned 30 years of global capital flows just proved false. In that environment, the asset that has no counterparty risk, that is not dependent on any central bank's policy, that cannot be printed or defaulted, that asset becomes attractive. Gold at this moment is not a speculation on future prices. Gold is a response to present uncertainty. The movement has already begun. The destination is unknown, but the direction is clear. Silver follows gold with amplification. Silver's move in the hours after Japan's announcement exceeded gold's in percentage terms, a pattern consistent with historical episodes of monetary stress. Silver's industrial demand provides a floor that gold lacks. Silver's smaller market provides volatility that gold absorbs, but silver also carries monetary memory. For 5,000 years, silver was money alongside gold. That memory does not disappear because modern economists declare it irrelevant. When monetary systems crack, that memory resurfaces. People reach for what their ancestors reached for in similar moments. This is not rational in the narrow sense that modern finance defines rationality. It is rational in the deeper sense, the sense that recognizes patterns persisting across centuries. Silver's move is not about Japanese monetary policy. Silver's move is about what Japanese monetary policy reveals, that the structures assumed to be permanent are not. The timeline of what comes next is uncertain, the direction is not. Japan's policy shift will not reverse. The Bank of Japan did not endure 37 years of criticism and market pressure to reverse course within weeks. The repatriation of Japanese capital will continue. It may accelerate or decelerate, but the direction is set. The stress on global bond markets will persist. It may manifest as higher yields, or as volatility, or as funding crises in vulnerable borrowers. The pressure on the dollar system will increase, not because Japan intends to undermine the dollar, but because Japanese capital was a pillar of dollar demand that is now weakening. And gold and silver will continue to respond to these dynamics, not as predictions of collapse, but as real-time indicators of confidence. The system is repricing. The repricing began at 3:17 a.m. Eastern Time. It will continue until a new equilibrium is found, and finding that equilibrium will require adjustments that many market participants are not prepared for. This is not a prediction of collapse. Systems do not collapse on schedule. They do not follow scripts. They adapt, adjust, and persist longer than critics expect, until they don't. This is an observation about structure. For 37 years, the global financial system incorporated Japanese zero interest rates as a permanent feature. Structures were built on that assumption. Leverage was taken based on that assumption. Portfolios were constructed around that assumption. The assumption just ended. The structures built on that assumption must now adjust. Some will adjust smoothly, some will not survive. The process of discovering which is which has begun. Gold does not rise, confidence falls, silver does not spike, systems crack, Japan did not hit a kill switch by intention, Japan normalized policy after decades of emergency measures. But normalization in a system built on abnormality is itself a shock. The largest monetary experiment in modern history has ended. The consequences are now unfolding. Not in Tokyo, everywhere, for those watching the signal rather than waiting for the narrative.